short selling is a survival skill. Now let's put ourselves into the shoes of investors. What do investors really want? I mean, like there's a classic joke, like what do okay, I want to know what investors want. Somebody walks up to God. I want to know what investors want. Oh, dude, do you have anything else? Well, I want a no, what do you want? I want a 4-lane highway to Hawaii because I don't like to take the plane. All right, and what? Sorry, it's too tough. Can I know what investors want? How do you want your 4-lane? It's too difficult. Well, it's very simple. One simple thing that investors want: they want to sleep. They want this. They want the Madoff type of return. And this is why I call it the Madoff case. The Madoff case is Madoff managed to lull investors to sleep. Investors want low correlated returns over time. And Madoff did 3 things that nobody else did. It was always up for business, so there was no big drawdown. It was uncorrelated. And the final thing is that with this, it doesn't have to be big. Investors are not looking for big returns, they're looking for consistency. And this is something that is important to understand. And how do you do that? Well, through short selling. Now, markets are really noisy. You know, there's no shortage of creation. Like there's tons and tons and tons of investment vehicles, but there's a big shortage of creativity in the financial services, which means that there's plenty of vehicles where you can park your money, but very few good vehicles where you can rest assured that things are going to work fine. By the way, if you have questions, go ahead. Start asking questions. So when it is time for asset allocations, how do investors think? You see, when markets are going up and up and up and up, people are quite happy. I mean, there's not much of movement. But on the other hand, every time the market tanks, what happens is those who still stand up stand out. So investors pay a lot of attention to months where markets are down, because when they see that the few guys are up, then it shows scale. And how do you get that scale? You don't get that scale by buying high dividend stocks. You get that scale by being a short seller. That's it. So the key to raising AUM, if you don't believe me, the key to raising AUM, ask John Paulson, ask Hein Horn, ask all the guys at the Big Short, all the guys who can make money on the in down market. The phone rings off the hook. Those who don't make money in down markets, well, guess what? They go the way under the door, and they deserve it. So, which leads me to supply and demand. Now, think about your career. There's ample supply of people who want to buy. There's ample supply of these guys. The other day I was talking to a friend of mine. He's a 50-year-old broker, and he said, yeah, but I'm a stock picker. And I told him, yeah, but you're obsolete. If you didn't get the memo, it's because nobody uses fax anymore. You're obsolete. You can't code, and all you do is find small caps running around doing corporate tourism. You need to learn to program, and you need to learn more skills. So the ample supply of people who want to buy, but very high demand of people who can short. So think about your career. If you want to be in the alternative space, learning to sell short is not a choice. You have to master the skill. Now, what comes with the skill is you will be a natural risk manager. If you learn to sell short, you will understand risk. You will have an intimate knowledge of risk. Because short selling is risky, will make you a stronger, faster, and better investor. The skills that you will master on the short side will help you on the long side. I mean, you know what? I think that ask Rambo. I think he can teach judo to people or Brazilian jiu-jitsu to people on a Sunday school, right? So that's that kind of level. Now, about short selling, it's very poorly understood. Thing here is, if we were to line up all the books about going, what to buy, how to buy, when to buy, and what to buy, trips to the moon, if we was to stack them one on top of each other, trips to the moon would be a sad ecological reality. You don't need SpaceX. You can walk your way to the moon with what to buy on the markets, just by stacking them up. Now, if we were to line up all the books about short selling on a table, there are 14 of them. 12 of them are completely off topic. I know I had to read them. I'm a short seller, so I had to read them to educate myself. If you were to line up line them up on a dinner table, there would still be room for a delicious Cabernet Sauvignon or maybe a Shiraz and 2 glasses. Point is, the subject is very poorly understood. It's poorly studied, poorly understood, which if you study it, if you study the craft, you're going to have a natural advantage over everybody else by definition. So we're going to go through all the myths, the classical myth that we hear all the time. The first one is the structural short. I used to work for a fund manager who said, oh, I want to find structural short. Now, every professional investors who publicly claims this looking for structural short is an imposter. Redeem, run, they're walking blow up. They're blow up walking. And let me explain you why. The idea behind this is people running around buying stuff long. They're very busy with their long portfolio. Then they dabble into short selling, fails, they get frustrated. Then they go and do it by, they tick all the boxes. I want something that has bad rating, a bad analyst rating, bad valuations, bad story, bad fundamentals, bad earning momentum, yada, yada. Basically, I want to find something that I can short and throw away the key. Now, if you think about it, we all know that short selling, we can all agree that short selling is difficult, more difficult than the long side. So if they're busy all day long doing what they love to do on the long side, because apparently it takes a lot of work, how is it logically possible that the short side, which is considerably harder, can be left unattended and unchecked? People who look for structural shorts are imposters who have absolutely no idea what short selling looks like. So run if ever you find anybody talking about that. The second thing is short selling is the reverse of long. Well, the short world obeys its own laws. It abides by its own rules. And my favorite retort to people, oh, yeah. Just going short is just the investor of going long. I'm like, okay, all right, no problem. Try it. Put your money where your mouth flap. Are you ready to put your money where your mouth is flapping? Go ahead. I'm watching. Go ahead. To this day, zero comeback. Short selling is a different skill set. It requires different rules that we're going to see. The third thing is there's infinite risk on the short side. Wrong, wrong, and wrong. Actually, people who believe that if people entrust you with their hard-earned savings, if they trust you with their money, for the people in an asset management business, if you watch the money of your clients evaporate and do nothing, just because the need to be right supersedes the obligation, the fiduciary duty that you have to your client, then you deserve to have your name passed down to posterity. You deserve to have your name sealed on a plaque at the bottom of a public urinal for the future generations to piss on it. Let that sink for a second. So there's actually, you need to learn stop loss. The point is, if you're on the short side, you need to learn stop loss. You need to learn to manage risk, and we'll come to that. The third thing is filters. Now, this is an interesting one. A lot of people come with preconceived ideas about short selling. All right, I'm going to short something that is expensive and I'm going to buy something that is cheap. It comes from the GARP, a growth at reasonable price method, where people want to buy something that is at a discount. It's the famous margin of safety. So they believe that the reverse of that is actually shorting at very expensive price. All right, let's see that for a second. So basically you would be shorting Netflix and you would be buying GE. Probably not a good idea. Or for instance, if you're doing cyclical stocks are machinery, chemicals, semiconductors, all these. Usually those stocks are very expensive at the bottom of the cycle because the price to earnings, because they don't have much earnings, and they're very expensive at the top of this. They're very cheap at the top of the cycle. So it's actually counter-cyclical. You would buy expensive valuation, you would sell into cheap valuation. So valuation doesn't really work. It introduces a filtering. Another thing that I've seen quite a lot is factor short selling. Now, factor short selling doesn't really work. It doesn't lend itself to short selling. So there's what I've seen quite often is like hybrid with what is that? Pairs trading. It unfortunately factors is interesting, but Apple is not like a bit of growth, a bit of what is that? Cash and so on and so forth. It's not a molecular cuisine. Apple is a story. Apple is a stock, for instance. The fundamentals. Now we're coming back to the fundamentals. Fundamentals. I used to compile financial statements. I used to be an accountant, so I have a fairly intimate view of that. And my first job in the financial services was around Enron time. So I actually uncovered frauds, quite a few. Being able to write financial statements and compile them, I was able to find them. I found 2 or 3. I found one which was NEC. NEC was a revenue recognition in the lease. It was well, basically they inflated their revenue in the US through leases, recognized revenues. So that was an outright fraud, and I found it in the notes to the financial statements, but it was only uncovered 3 years down the road. So going through this, it doesn't really work. Another good example of that is, for instance, Bill Ackman with the Herbalife. His need to be right was stronger than his obligation to make money. So he ran around, sent letters to the FTC to tell that Herbalife was a scam, Ponzi scheme, and so on and so forth. He lost $1 billion. Too bad. And one of the final myths is what I call the narwhal hunting. So narwhal hunting is people coming from the long side, usually hold the belief that good ideas, good stocks are few and far between. Like they want to have concentrated good ideas that they can ride into the sunset. Now, if you transpose that to the short side, given the asymmetry of information, there's no shortage of news on the long side, but on the short side, it's very difficult to find information. Like companies are notoriously introvert with bad news. There's no budget freeze on a good PR, but there's always like omerta, silence on bad news. So with all this, if you think that on the long side ideas are few and far between and you're a whale hunter, if you transpose that to the short side, you'll have far fewer ideas. So basically you'll be hunting unicorn whales. You'll be running around the Arctic Circle hunting for those elusive whales called narwhals. The short side doesn't work like that. It cannot work like that. This is what will come to the next thing, which is the outcome quadrant. So this is an important part. This is how we human beings define what we do, by the outcome. So when you create a strategy, in theory, you create a strategy, you have true positive and true negative. Everything's fine. Now, with true positive and true negative is at the conceptual space, everything works fine. Then you take your strategy for a spin, and all of a sudden, first encounter with reality, the first encounter, when theory has its first, no theory has survived its first encounter with reality. Boom, you have false positive. You thought you had the signal, and unfortunately it doesn't work. So the next reaction is, well, I'm going to reduce the false positive. I'm going to impose another condition. So you marginally reduce the false positive, you increase your true positive, and so on and so forth. And then the dance goes on and on and on. Basically, what happens is, all right, let's say it basically to give you, let's say, for instance, okay, I'm going to short something that is expensive. All right. So you're going to start shorting Netflix. It doesn't really work. Okay, I'm going to start something that has, I don't know, above the 200 demystifies, or I don't know whatever it is. You're going to start increasing conditions. Let me give you a practical life example. Let's think of it as dating by checklist. So originally, there we go. True positive, true negative. So what happens is you're going to increase the number of conditions. And dating by checklist. Let's say, all right, I want to date a a lady. All right, good. There are 3.5 billion of them. Congratulations. All right, I want to date them between the age of 20 and let's say 50. All right, that reduces to, I don't know, 1.5 billion, something like this. All right, I want to date them within 2,000 kilometer or 2,000 kilometer radius. All right, that reduces to 1 and so on and so forth. I want to date them above 1.75 centimeters. All right, that reduces to 500,000. I want to date a rich, single, yada, yada. Okay, that reduces to 100 and so on and so forth. So what happens here is you have something that is called, well, you keep on reducing, well, you keep on adding conditions, you have all these false negatives, which means that you have the desired outcome, but you don't have a signal. Your signal engine machine stays mute. So what this is something that I've seen quite often with short sellers is even in 2008, I remember there were brokers, but we can't find short ideas. Like, dude, the market's melting. Lehman just collapsed a couple of weeks ago. I think there's no shortage here. No, but you don't understand. There's there's no good idea over there. There always is. As a matter of fact, one question for the audience to make sure that you're not entirely asleep. How many underperformers do you think there are today in the S&P 500? As of today, we're October 10th. How many? Just if anybody has an answer, please go ahead. Any answer? 100? Yeah, that's a good one. 150? Yeah, we're getting there. Let me give you the answer. This chart is the number of these are outperformers, single count, and these are underperformers, single count. So these are days in the market, and this is what the S&P looks like. So every day you have roughly half the index outperforming for half the index underperforming. And this is the method that we're going to see. This is the essence of the course. What I'm trying to say here is this course is not about trying to impose conditions to narrow down. This course is about identifying underperformers, outperformers. You want to buy outperformers and you want to short underperformers. It's not very difficult. This is the current number that we have. Now, how are we going to do that? And this is what the promise of the course, this is what it looks like. So as I said before, I want this course, really wanted to write this course for, this is the promise. This is really what I wanted, to pack as much value as I can. So you'll be able to reclassify your universe within 3-4 minutes. So typically you arrive at the office in the morning, you push the button, and within 3-4 minutes, you'll have this. You'll have, all right, these are my outperformers, these are my underperformers every single day of the week. It's not bad. Second thing, you want to have a stable regime definition. So the last thing you want is to have a career politician kind of regime definition. One day it says yes, the next day it says no, and the third day it says maybe. You want to have something stable on which you can articulate a strategy. And you want to have something that is non-invasive. And the method that I'm about to teach you is completely non-invasive. It works with fundamental people, it works with quantitative people, it works with technical people. It's just something that you add, and we'll see the stats later. The bottom and peak out. So the other day I was having a coffee with an ex-colleague of mine. He babysits a big pension fund somewhere north of 3 USD yards, or about 3-4 billion. It's fairly big. And I was explaining this, and he smiled. Well, I mean, we've been long-time friends. He smiled. He said, "How soon can I get that?" Because you'll be able to identify stocks that have bottomed out, and it's a pure long-only fundamental traditional cap. This gentleman, that's what he does. But he loved the idea of being able to identify stocks that have bottomed out when the street is terminally negative and they start to outperform. And we run through a bunch of stocks that he wanted to see. The street is negative, earnings is, momentum is negative, sentiment is negative, yada yada. And he suspected that those stocks would have bottomed out. And running the script, we saw that. And similarly, he said, "Oh, I think that these guys are a bit too much euphoria. a bit overpriced and so on and so forth. So we looked at them, and fair enough, 2 out of the 10 he showed me, 2 out of the 8 he showed me had peaked out. So this is an objective method. This is something you'll have. Idea generation. Now that is a big one. Everybody wants signal. Now let's go back to that chart. This is how many signals you're gonna have, half the market. So typically within a month after you finish the course, you'll be running up to your boss, you'll be walking up to your boss. Hey boss, I got another bunch of ideas. You'll be like, Einstein, slow down. Within a month, you gave us more idea in a month than we have to money to deploy over a year. So literally, you'll have the comfort with this, with the stuff that you learn in there, and this is a promise. You'll have more ideas than you will ever have capital to deploy. You'll have a high quality problem. How can I deal with so many ideas? And do not hesitate. If you have questions, if you want to have clarifications, please do ask questions. The next thing is you'll have a screening. Now the screening is this is a, where is it? Should be somewhere around here. Oh no, so a bit. We'll go through that in detail later. The screening is basically you'll be able to press a button and have everything you want. Then we'll go through strategy definition. So how to define a strategy. This one is not going to be complicated. And again, the idea is to give you the building blocks of how to define a strategy. What are the questions you need to ask yourself? And an interesting one is stop loss. Being a short seller, my belief about short sellers, it's all about being able to, how to define a stop loss and how to honor it. Everything else is a nice coffee kind of conversation. Everything else is just secondary. We'll backtest this, and then we'll do optimization. And I'll give you 3 risk metrics. Now remember, we are on the short side. The environment does not cooperate. We'll test for robustness. I mean, there's only one time where I roll my eyes at people is, oh, I've backtested and I have a Sharpe of 2, yada yada. Oh, come on, please. We'll backtest for 4 specific things. We'll backtest for drawdown, where we'll use metrics that test drawdowns, the metrics that test whether your mean reversion or trend following strategy works, and then use metrics that test for frequency of trading. All those packed into 3. Then we'll move to my favorite topic, which is position sizing. We'll have a few libraries, like a few ideas, money management, and then we'll conclude with a aha moment. Okay, now let's go. Quicker. Let's go down to the course structure. We're going to move through here, and I'm sorry, I apologize for not being really tech savvy. So this is a bunch of photos. Maybe we're going to put them into a, what's that, how you call it? PowerPoint, yeah. But this is a bunch of pictures that I've taken for the source code. So the first thing is we're going to go to the relative series. The relative series is this. If you trade multiple markets, let's say you trade all Asia or Asia X, you're going to have ringgit, you're going to have rupee, you're going to have Hong Kong honkies, you're going to have Singapore dollar, you're going to have Japanese yen, you're going to have Korean won. You're going to have a lot of currencies. How do you put them on the same plateau? Then let's say you do MSCI World, you're going to have all currencies from all around the world. So you need to be able to restate them in a single currency and a single market so that you compare apple with apples. So let's see an example. For instance, these are like automakers, Ford, GM. This is a tech stock value. This is an auto stock valued as a tech stock. Tesla, Toyota, Nissan, Honda, Renault, Volkswagen, Fiat, Maruti, Tata Motors. So you can see makers from all over the world. This is an absolute and local currency. There's not much information there. Now let's look at them in MSCI World, relative MSCI World, and what is that? In USD. So everything is restated, and now you have a very clear definition. All right, this one, what is it? Fiat, not looking good. Tesla, maybe it has bottom. I don't know. I have no idea. And you can see all the other ones. So basically, you can make arbitrage now. You can put everything on the same plate. So the question about this is, all right, let's say, for instance, this one is a short. How can I know with a statistical certainty or reasonably certain that it has bottom or that it has peaked out. So this begins the question of regime. Regime definition is, there are basically three classic methods. So we'll go through two of them, and then we'll look at one that I invented. The first one is basically 52-week or 52-week high, 52-week low. So this is IBM. So basically, every time it prints a 52-week high or 52-week low, this is in relative, of course, then it's bullish. Oh, it prints a 52-week low, it's bearish, bullish again, and so on and so forth. Now, interestingly enough, one apart about this method is it reacts really well in sideways markets. Sideways breakout, it does work well. That's something that this method does well. It doesn't flip-flop a lot in sideways market, and it catches long-term trend. The drawback, as we will see later, is that it lags a lot. As you can see here, it takes forever. All right, moving on. So we'll see another method, which is called the moving average crossover. And this is a classic that unfortunately has a horrible win rate, horrible gain expectancy, which is the moving average crossover. I think this one is 50 and 200-day moving average. This is another classic regime definition. So you'll have the chart make pretty close like this. As you can see, all right, this is Senate, this is Congress, this is Senate, this is Congress, this is Congress, this is Senate. Basically, it flip-flops like a career politician. When things go sideways, it flip-flops like a career politician. So you have whole Washington here, and you have all country politicians. And this is the Brexit, basically. This is, so one solution that people have is, all right, it doesn't really work. So they often use a triple one, which is dual, they call it dual momentum. So a long-term one that defines regime, a short-term one, and a mid-term one that defines entry and exit. As you can see, it's better, but it's still not pretty. And then we'll see this one, which is the floor and ceiling. So how does it work? This originally came from the higher highs, higher low, and I realized that actually higher highs, higher lows has 4 conditions, whereas this one has only 1 condition. So because we're in the market and things are random, stars do not align all the time. How does it work? The idea is, as you can see, here's a dot, and then we look at a low. We look at the lows. If the low is very close to the bottom, then there's nothing happening. It might be a sideways market. If the low starts to move up quite with some distance, 1.5 standard deviation, which is 80% in the cumulative distribution, I know markets are not linear, but 80% cumulative distribution is still a good number. If the low is 80%, there's a 1.5 standard deviation from the bottom, it's worth taking a trade. You place a stop loss. If it works, it's likely to go up. If it doesn't, hey, you have a stop loss. Fair enough, it works. So the strength of this method is when you have big counter trend, oh, this is a bear market, this is the end of the world, da 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 da. This is not when you sell. You actually end on a high. So you buy at a low, and the regime reverts at a high, or shortly thereafter. So bull market, you buy them at the low, and you exit, you start a bear market at a high, which is, and it's fairly stable. As you can see, it doesn't flip-flop all the time. This is not politics. We're not in Washington or wherever, or France or Brexit or whatever you call it. They're all the same. So this is in relative. Before was in absolute. Now, next thing, we're going to overimpose the moving average. And as you can see, one drawback of the floor and ceiling is if you just use this one without working orders, it might not exactly, it is volatile. As you can see, the moving average still doing its thing, not really pretty. Absolute, relative,